Welcome to CRE TV and radio. In this video, I'm talking with Adam Deermount, founder of Ranch Harbor, spelled as one word, in Orange County, California. Adam and I will be discussing the state of commercial real estate finance in February of 2021. I just finished a webinar discussing the state of the CMBS market. And in order to watch that video, there should be a link on the top right-hand corner of this video. So click on that if you want more detail. That was a great conversation where we explained what the CMBS market is, how it differs from the CLO market, and what's going on. Now, let me move on. If you like what you see in this video, remember to subscribe, hit the subscribe button and the bell. Let me do that again so you can see it. Hit the subscribe button and ring that bell, and in that way, you'll get a notification each and every time that I post a new video. Now, let me introduce myself. My name is Howard Klein. I've been a California licensed attorney for over 4 decades. Actually, it's a little longer than that. And much of my focus has been on commercial landlord-tenant matters, including lease negotiations, evictions, rent collections, and foreclosures. I'm also starting an arbitration practice where I'm going to sit as an arbitrator, a remote arbitrator, specifically on landlord-tenant disputes. Now, why don't I move on and let's meet Adam. Adam Deermount is, and here you see I misspelled the name of Ranch Harbor. Adam is a co-founder and managing director at Ranch Harbor, an integrated commercial multifamily real estate investment, asset management, and capital advisory firm based in Newport Beach, California. I've lived in Newport Beach, actually right off Pacific Coast Highway. Really nice. With over 16 years of experience as a lender, investor, and advisor within the commercial real estate home building industries, Adam has advised clients on billions of dollars of capital transactions across all asset classes. He is currently developing Ranch Harbor's investment and receivership programs, and hopefully in the future, during this discussion, he'll tell us a little bit about what he's doing. So now let's move on and say hello to Adam. Adam, how are you doing?
Howard, I'm doing great. Thanks for having me on the show.
Thank you very much. So without further ado, why don't we move on to your first slide?
Sure.
All right. So here we go. Now, why don't you start telling us what that is and what you want to talk about as it relates to the slide?
Sure. So what I like about this slide, and this is from Real Capital Analytics, and they did a deeper dive earlier in the year on the composition of where debt financing comes from in the U.S. capital markets today versus where it came from in 2007. And if you take a look at this slide, it's very different. CMBS had a dominant 64% share back then. Everything else was kind of compressed, and now we've got a bigger gain from banks and from investor-driven lenders or debt funds. And here's why I think this is really important. The capital markets today are interesting, going back to what we saw in the last recession. I think we're hardwired to kind of look at what happened the last time and assume that what's going on now is going to be reflective of that. And in this case, it really isn't. 2007, 8, 9, 10, we saw an environment where the capital markets just shut off for an extended period of time. It caused a ton of distress. Part of that was due to the lender composition. You had a lot of CMBS, that there was distress in that mortgage bond market. You needed to sell into that market, and it was difficult to price. What we saw this time around was back in March, we hit a wall. and everything stopped. There was a period of time where there were some fairly prominent non-agency mortgage REITs that were trading at a level where their implied dividend was like north of 50%. I mean, priced to go out of business effectively. And I think a lot of people looked and said, okay, this is going to be 2007, 8, 9, 10 all over again. But what's happened since then that's been interesting is we really have seen a recovery. There's still distress in some product types, but by and large, the unprecedented moves by the Fed, by the Treasury, have kind of revived the capital markets to the point where we're still seeing bridge to bridge, where a deal hasn't really, or construction to bridge, where a deal hasn't really completed its business plan, but there's still capital out there that is coming in and is willing to extend that out and kind of give them a lifeline. Might be a little more expensive, but that's not what we saw back in 2008.
Okay. All right. You want to move on to the next scene?
Sure.
Okay. So let's move on to this.
Sure. And in this slide, again, from Real Capital Analytics, you really get an idea, and this speaks to the capital markets as well, just how bifurcated this market has become. And this is price trends, but it's also reflective of the underlying financing. The apartment market, by and large, has held up well outside of some big cities. Say if you're looking San Francisco, New York, even LA, there are a lot of issues. People are leaving those markets. They were very expensive to begin with, but the agency element of apartment financing really allowed that to hold up well, even in the darkest days of March and April, where some of the debt funds out there that were reliant on back leverage, either warehouse lines or CLO, were dropping deals. On the industrial side, everything that's happened so far this year or last year only strengthened industrial, other than some maybe really small tenants in the manufacturing space. By and large, industrial space in most U.S. markets now is warehouse and distribution, logistics. And we saw a dramatic acceleration in adoption of e-commerce. So when you're talking about the capital markets broadly, it's really hard to underwrite a retail deal, and retail was distressed before this. It just accelerated that. A hospitality deal, which kind of hit a wall. And then office, we've been cautious, bearish on office for a while now, where longer term, as the technological barriers have broken down through platforms like Zoom, the social barriers have also broken down on remote work. And, it's going to take time to see how that plays out in the office market. And there's still capital available for office. I would just say it's more conservative than what it was, maybe far more conservative before the pandemic.
Now, maybe I'm reading this wrong, but I'm looking at the line for hotel and the line for retail, and I was surprised to see retail worse than hotel.
Yeah, and this is a little bit so. This is speaking in broad sectors. I think if you looked at elements within hotel, say the luxury sector is performing much worse, the economy section is performing much better. Retail, I think, is greatly impacted on something like this by malls, where if you were to look at grocery anchored centers, it's performing substantially better than this.
Sure.
And I was somewhat surprised at that as well, that hotel has maybe stabilized a little bit more. And part of that might just be an underlying bid where, hotel had a traumatic acute shock early in the year. Retail has been on a downward trajectory, broadly speaking, for a very long time now.
Yeah, absolutely. That doesn't make the people at ICSC very happy. Okay,
I
so
can't
let's move
imagine it
on.
would.
Let's move on to the slide U.S. distress inflows by property type since '07. Why don't you tell us what you've got there?
Sure. So this really spells out what's going on well, which is that the level of distress in the capital market that we see today is really distress. It's a story about two asset classes, hospitality and retail. Once you get outside of that, there's really very little distress. Now, I anticipate more in the office side of things, but I don't think we're going to see much of any in industrial or multifamily. And really, a lot of what we're seeing with lenders now is they're increasing their allocations for 2021. They're dropping spreads, which spreads when we came out of the spring were actually quite wide because nobody really knew how anything was going to get priced once the market started moving again. But they're really focused on industrial, on multifamily, and then on some other more niche product types that, self storage, data centers, that sort of thing. Where retail and hotel, as you get into underwriting here, there is capital available for them. I do want to keep stressing that it's not that they're completely shut out of the capital market, but it's got to be well underwritten, and you have to be able to withstand a higher cost of capital to account for the risk in those product types. But it's really kind of shocking when you look at this. I mean, go back to 2009 and 10 and look at how kind of evenly distributed the distress was, where today it's anything but.
Okay. Let's move on to how prices are holding up.
Yep. Um, this is going to be a really interesting story this year. Um, there's been a ton of money out there on the proverbial sidelines that's been raised to capitalize on distress. And it's not in real estate, although that's our focus here. There was an article in Bloomberg this morning about how a lot of hedge funds that assumed that they were going to have all these distressed situations in consumer credit, in real estate, and in corporate debt really haven't had any place to put their capital. And what you're seeing here is that distressed sales are low. Now, part of that is because some of your major asset classes, industrial, multifamily, are not distressed. Another part of it is that you're still seeing kind of the kick the can down the road forbearance mentality from lenders, which has kept that out of the market. And what it's really doing is kind of creating an environment where you have tons of cash on the sidelines watching for distress, but the distress hasn't yet developed, hasn't yet hit the market.
Yeah, this was something that we were talking about yesterday, where TREP, the data that it collects, one of the points, TREP relates to the CMBS market and the CLO market. If there is a forbearance agreement, it doesn't go to special servicing, and it's not considered to be in distress according to their data. And they do know that there's a substantial amount that's in forbearance. The problem is we're not going to see problems with that, and it's not going to be considered a distressed loan until when the forbearance agreement terminates. So
Yeah.
they're anticipating, apparently, sometime this year, and as you pointed out, 2021 is going to be an interesting year. We're going to see more distressed sales,
Yep.
and I like to refer to it as the shadow effect.
Mm-hmm. Well, I think one of the things that is going to be really interesting here when we look at distressed sales is, are prices going to fall to a level where equity is eroded and you're seeing debt trade at a discount? true distress, what we saw back in the last recession. And a little bit of an interesting analog to this is something I've been blogging about now for several months, is every few weeks somebody will come out with an article on how all of these forbearances are piling up in the single family space for homeowners. That mortgages are in forbearance, so they're not technically in default, but there's tons of money owed, and that this is going to result in a wave of foreclosures and distress like what we saw in 2008. I don't believe that's going to happen this time. And the reason why is there's a critical difference between 2008, 9, 10 and 2021, which is that homeowners have equity this time around. The distress has piled up as the market's been going up. And in addition to that, you don't have exploding mortgages and pick a payment and all the garbage that was shoveled on people back in the last recession or leading up to the last recession. So what I think you're more likely to see, and some of the bigger single family home for rent platforms have been out actively raising money around this, is a deployment of the sale leaseback model in residential housing. And that's been a great model in commercial for decades at least. But you really haven't seen it in residential. And what that'll do is it takes away some of it. It allows the single family rental platform to grow at scale, to get at more existing assets. It allows the seller, the homeowner, to extract that equity cushion that they have to cover living expenses and rent, and also keeps them in their home so that you don't have the displacement that you had in the foreclosure crisis the last time around. And where sale leaseback may not be the solution here on investor deals because it's an investor that's losing it, I'm not convinced with the amount of capital on the sidelines that we're going to see kind of the deep price drops, even though there are going to be distressed sales and workouts with some of the lenders.
Okay. So, what else do you have that relates to the commercial real estate market and finance? In closing, I might add.
Sure. So I think this year we're seeing something interesting in 2020, and it doesn't show up in a lot of places, but it's real. There's a lot of what I categorize as must place capital in the investing universe in real estate. And what I mean by that is pension fund advisors, endowments, institutions that get an earmark, and they're not being allocated that money to sit in cash and wait for a better buying opportunity. Again, unless it's a targeted distress fund that has certain parameters under which it has to invest. And what we really saw in 2020 was there were a couple of asset classes, short of major declines in value, that effectively got sidelined and became uninvestable. Nobody was going to go out and, for the pension fund that they were acting as an advisor for, go buy a big hotel portfolio unless you could pick it up for pennies on the dollar, which what we've seen with forbearance has not happened yet. So I think what effectively happened is when major asset classes like hospitality, like retail, and to a lesser extent like office, where a lot of institutional capital goes, becomes sort of uninvestable, you see capital routed towards the investment asset classes that are still investable. And I think that's part of the story where we've actually seen, again, aside from some gateway markets in multi, and aside from maybe some small manufacturers and industrial, this wave of capital, which has actually started to condense cap rates some, which is kind of an interesting story, as you look at where major capital flows are going. And the single family home for rent side of things has benefited that as well as a relatively young asset class. But it's something that as we continue to see distress or building distress in hospitality, retail, and office, that I think should be watched this year.
What are your thoughts on the geographical issues and how that the distress varies from location to location.
Yeah, I think so. A lot of what's going on from a geographical standpoint is something that started happening a lot earlier than is commonly recognized. Um, we saw this inflow to the cities back in a decade ago, where we had this wave of younger people in the millennial generation that were not in a financial position to buy. There was a ton of distress in the market, and they really valued um, community and mobility over the stability of being a homeowner. At the same time, there are a lot of articles written, and I always kind of chuckled about this, that by mostly urban journalists, that this very much jibed with their worldview. That, well, the millennial generation is never going to own cars, they're never going to own homes, they're going to be urban city dwellers forever. And I think I'm always kind of naturally skeptical when I look at something like that and say, okay, is this just verifying the author or the speaker's worldview? And in a lot of cases, it was, because when you took a look at what people were actually saying, it wasn't that they didn't want to own a home. They were young, they enjoyed living in the city, and they didn't have the finances to own a home. Well, starting 14, 15, 16, we started to see those people form families and realize that maybe that 2-bedroom apartment in Soho was great when you were single or even married, but once you had kids, it kind of became a little bit difficult to pull off. So people started to leave the cities. Then we get to 2020, fast forward a little bit, and COVID hits. And all of a sudden, you're stuck in an apartment, and every reason that you had to be in that city, every great thing about the culture of that city is gone. And every negative about living in that city has now been enhanced, especially, people with a young family or roommate situation, you're just holed up in an apartment. So while remote working suddenly became a possibility through widespread adoption of technological advancements that were happening on a slow basis, people looked and said, well, why am I spending all this money to be here when I can go somewhere else? And that's where you're really seeing this dispersion uh, of uh, of people into areas that previously maybe didn't have the employment base to support what was people moving there, or the type of jobs to support people moving there. But now people are looking for more space. They're looking for a higher level of amenitization in their living situation, because we're consuming our living situation like never before. It's now an office, a homeschool, a gym, where before it was where we went to eat dinner and sleep.
Yeah,
But one
go
other
ahead. I'm
just
sorry.
quick point on that is we're seeing it across all demographic groups. Aside from essential workers that need to be there in person, we're seeing it everywhere. I mean, we were seeing it at the ultra high end in places like Hawaii. We're working on a capital raise on the big island of Hawaii, where most of the people that are likely to be buying the homes that are getting built are Silicon Valley, effectively refugees that got out of Silicon Valley or San Francisco, and now they're able to work remote there. And there's been a ton of demand with little to no supply.
Yeah, we're seeing this all over. Is that there's a flight from high tax states, urban cores, um, but in my experience living on Long Island, being born in the early 50s, and living in New York for the better part of the first 20 years of my life, I've seen the ebb and flow of urban favor
Yep.
and disfavor. And it comes and goes, comes and goes, comes and goes. And right now it's going,
Yep.
but it'll be coming, So this may
Absolutely.
be a good time to make an investment. So I want to remind everybody that to subscribe and hit the bell, and so you can get something new. Adam, why don't you tell everybody how they can get a hold of you?
Sure. So the best way to get a hold of me is our website, Ranch Harbor, RanchHarbor.com. I write a daily blog during the business week called Basis Points. That's on that website, and my email and contact information's on there.
Now, are you focused predominantly? I got to remember which camera I'm looking at. Are you focused predominantly on capital raising? I thought I saw on your website something about asset management, etc.
So we do both. We have an investment strategy on behalf of a family office in California where we buy sub-institutional multifamily and warehouse assets in the Western U.S. And we partner with experienced local sponsors to do that. Generally, the capital raises there or the investments there are somewhere between $2 and $8 million, existing property and value add deal profile. We also work on the capital raise side on behalf of clients that are looking for capital in spaces that we don't invest in that fall outside of our box. We do a lot of home building. We do a lot of ground up. We do some perm debt. So we're really kind of a Western U.S. centric, although we do look outside of that area sometimes. And on bigger deals or ground up, we tend to do that as a third party advisor.
Great. I want to mention to everyone that you and I were connected on LinkedIn, but we didn't really know each other that well. And I think I reached out to you. I don't recall
You
exactly
did.
how,
Yep.
but this is part of what I'm doing here with the videos is I'm networking. So now you and I know each other. Maybe I'll be able to refer some business to you. You can refer business to me. And hopefully it'll benefit everyone. So you should, if you're watching this, connect to both of us on LinkedIn, not just to sell us something, please. If I say yes that I want to link to you, I'm okay with it. I don't want to have the very next second an automated I got some property for you, or I've got a loan for you, or whatever. It's developing a relationship. So, with that being said, anybody here, if you're interested, you need some financing or you need some advice on financing, please contact Adam. Or if you need any advice or representation with regard to landlord tenant matters in commercial real estate, please feel free to contact me. And with that, I think we're done, Adam. Thank you very
Thank you,
much.
Howard.
And you have a
Appreciate
great
it.
weekend. Yeah, appreciate
Thank
you.
you.
And
You too.
hopefully we'll continue on with our relationship. Bye bye.
Absolutely. Bye.